Investing out of state might sound complicated or even risky at first, but in today's market, it's one of the most practical and scalable strategies you can use. Investing out of state gives you the ability to move beyond the limitations of your local market and focus on opportunities where the numbers actually work. If you've been analyzing deals in your area and struggling to find anything that produces consistent cash flow, you're not alone, and more importantly, you're not stuck. In this video, we're going to break down exactly how investing out of state works, how to choose the right market, how to identify a strong investment property, how to build a reliable team, and how to create a system that allows you to scale without needing to be physically present. Let's get into it. Why investing out of state is becoming the go-to strategy. Right now, one of the biggest challenges investors face is that their local market simply doesn't make sense anymore. Prices have increased, interest rates have shifted, and competition has become more aggressive. As a result, many properties either barely break even or require a large amount of capital for very little return. That slows down your ability to grow. Investing out of state changes that completely. Instead of being limited to one location, you can choose from multiple markets across the country and focus only on the ones that align with your goals. This allows you to prioritize cash flow, scalability, and long-term stability all at once. Think about it this way. If you invest all your capital into one expensive property that produces minimal income, your growth is limited. But if you spread that same capital across multiple investment property opportunities in different markets, you increase both your income and your flexibility. You're also reducing risk because your portfolio isn't dependent on a single location. This is one of the biggest strategic advantages of investing out of state. The mindset shift that changes everything. One of the biggest reasons people hesitate to start investing out of state is because they feel like they need to be in control of everything physically. They want to see the property, meet the tenants, and manage the details themselves. But that approach becomes a bottleneck very quickly. Even local investors struggle to scale when they try to manage everything on their own. The investors who grow consistently understand that real estate is a systems-driven business. Whether your investment property is down the street or in another state, the goal is to create a process that runs efficiently without your constant involvement. That means building a team you trust, setting clear expectations, and focusing on performance instead of proximity. Once you adopt that mindset, investing out of state becomes much more realistic and much more powerful. Step 1. Choosing the right market. Market selection is the foundation of your success when investing out of state. Choosing the wrong market can create unnecessary challenges, while choosing the right one can make everything else easier. Start by analyzing population trends. Are people moving into the area, or are they leaving? Population growth is one of the strongest indicators of future housing demand. Next, look at job growth and economic diversity. Markets with a mix of industries such as healthcare, logistics, education, and technology tend to be more stable and resilient. Rental demand is another key factor. Look at vacancy rates, how quickly properties are being rented, and whether rents have been increasing over time. These indicators help you understand how strong the rental market really is. Affordability is equally important. You want to find markets where purchase prices are still reasonable compared to rental income. However, be cautious of markets that seem too cheap. Often, there are underlying issues such as declining population or weak job growth. The goal is to find a market that offers both affordability and stability. Step 2. Identifying a strong investment property. Once you've selected a market, the next step is identifying the right investment property within that market. This is where your ability to analyze deals becomes critical. Start with rent comps. Look at actual rental listings and recently leased properties to determine what the property can realistically generate. Do not rely solely on estimates provided in listings. Next, break down your expenses. This includes property management fees, maintenance, property taxes, insurance, and vacancy. It's important to be conservative with your numbers so you don't overestimate your returns. Then calculate your projected cash flow. A strong investment property should produce consistent income after all expenses are accounted for. You should not have to rely on appreciation alone to justify the deal. One effective approach is to stress test your deal. Assume slightly lower rent and slightly higher expenses than expected. If the property still performs well under those conditions, you're looking at a much safer investment. Step 3. Building a team you can trust. Your team is what makes investing out of state possible. Without the right people in place, managing from a distance becomes difficult. With the right team, it becomes a system that runs efficiently. The most important person on your team is your property manager. They handle tenant placement, rent collection, maintenance coordination, and communication with tenants. A strong property manager protects your time and your investment. You'll also need a real estate agent who understands investment property and can help you find deals that match your criteria. A reliable contractor is important for handling repairs and renovations, especially if you're buying properties that need some work. And a thorough home inspector will help you identify potential issues before closing. Take your time building your team. Ask detailed questions, review their experience, and look for professionals who are familiar with working with investors. This step is critical to your long-term success. Step 4. Financing and leverage. Financing plays a major role in how quickly you can scale when investing out of state. Many investors use DSCR loans because they are based on the income of the investment property rather than personal income. This makes them especially useful for investors who want to continue growing without being limited by traditional lending requirements. With a DSCR loan, the focus is on whether the property can support its own debt. For example, if your monthly payment is $1,000 and the property generates $1,300 in rent, that creates a positive margin. This type of financing allows you to continue acquiring properties as long as the deals make sense. Over time, this can significantly accelerate your portfolio growth. Step 5. Managing from a distance. Once your investment property is operational, your role becomes one of oversight rather than direct management. You should regularly review financial reports, monitor income and expenses, and stay in communication with your property manager. At the same time, avoid micromanaging. Trust the systems and team you've put in place. It's also important to maintain reserves for unexpected expenses. Repairs and vacancies are part of the process, and being prepared helps you stay consistent. When everything is set up correctly, managing from a distance becomes predictable and efficient. Common mistakes that can slow you down. One of the biggest mistakes investors make is focusing only on the purchase price. A cheaper property is not always a better deal if it comes with higher risk or lower demand. Another mistake is skipping due diligence. Always verify rent comps, review inspections carefully, and double-check your numbers before moving forward. And finally, underestimating the importance of your team can create major issues. The wrong property manager or contractor can impact your returns and create unnecessary stress. Scaling across multiple markets. The true advantage of investing out of state is that it allows you to scale beyond a single location. Once you have a system that works, you can repeat it across multiple properties and even different markets. Some investors focus on high cash flow markets, while others balance cash flow with appreciation. By combining different strategies, you can build a more resilient portfolio. This approach allows you to grow consistently while reducing risk over time. Real example breakdown. Let's walk through a simple example. In a high-cost market like Atlanta, you might spend $350,000 on an investment property that produces little to no cash flow. Now compare that to investing out of state, where you might purchase a property for $160,000 that rents for $1,400 per month. After expenses, that could generate around $300 in monthly cash flow. If you repeat that process 5 times, you're generating $1,500 per month. 10 properties would put you at around $3,000 per month. The key is that once you build the system, this process becomes repeatable. Long-term perspective. One of the most important things to understand about investing out of state is that it's not just about short-term cash flow. It's about building a portfolio that performs over time. As rents increase and properties appreciate, your overall returns improve. At the same time, your systems become more refined, making it easier to manage additional properties. This is how investors transition from owning a few properties to building a scalable portfolio that generates consistent income. Closing. If you've made it this far, you're already thinking differently than most investors. Investing out of state is not about taking unnecessary risks. It's about making smarter, more strategic decisions. When you focus on strong markets, analyze each investment property carefully, and build a reliable team, you create a system that can produce consistent results over time. The key is to treat this like a business. Stay disciplined, follow your process, and focus on long-term growth. And once you understand how to consistently identify a strong investment property, scaling becomes something you can do with confidence. So if you want more content on investing out of state, real deal breakdowns, DSCR loan strategies, and step-by-step systems to help you grow your portfolio, make sure you hit that subscribe button and turn on notifications so you don't miss the next video.